And so I think we're in an environment where the large banks are pretty well protected, whereas small banks probably still face ongoing challenges. Now, I'd be careful about chasing things in the near term. I mean, short-term moves can always reverse themselves over any multi-week or multi-month period. But I do think that Bitcoin is showing a lot of resilience in the recent months. So I see a lot of people blaming, either the banks or blaming the Fed exclusively, whereas like most things, it's a mix. And so basically, it's kind of a toxic policy combination and just individual bank mismanagement. Not in the same way in 2008. In some ways, it has parallels to the 2019 repo rate spike. Which not everybody's familiar with, but it's more severe than that, but not as severe as 2008, at least in the United States. And the reason I would describe it like that is 2008 was really a credit problem, which means that banks made very aggressive and ultimately bad bets. They lent money to entities that defaulted. Whereas here, we're not really seeing that. It's not like they got overly aggressive and made bad loans that are defaulting. Instead, what they did was they ironically bought very, very safe assets, but they bought them at high prices, meaning low yields. And as yields have gone up at like a multi-decade high rate, a year-over-year rate, a lot of those securities are now underwater in price. And it's actually fine if they're able to hold on long enough because those securities will pay back all their money, or at least, the vast majority of them. The problem is that if they can't hold on long enough, if their deposits get pulled out and they have to sell their assets for a loss, that's when they basically make those losses real. So I would say this is essentially a shock to the system when you raise rates this rapidly. And then it kind of finds out which banks manage that exposure better than others. There's two big risk factors that go into why this particular bank had such a big problem. One was that their deposits were not very high quality because they were concentrated in one industry, tech startups. And because they're mostly business bank accounts, most of them were well above the FDIC limit. And so they had, they're at risk of loss if there should be a bank failure. And so they're basically deposits that are very, very quick to want to move at any sign of a problem, which is not the case when you have a very diversified and smaller, kind of a large number of small accounts. So one is their deposit base was at risk, and the number two is they did not manage their duration well. A bank like JP Morgan, for example, got more into shorter duration types of assets, so they had less losses when interest rates increased so much. Whereas this particular bank, basically made a pretty big bet on long duration assets, which is not like the riskiest thing you could have done, but it is risky because those are relatively safe assets, but they have pricing risk. And so that bank had a particularly large amount of losses relative to its capital and had a very flighty deposit base. And then there was a big decision of whether or not they want to back up all depositors because most of them were uninsured. But at the same time, the policymakers want to restore confidence in the rest of the banking system. One of the big challenges is that, of like the 17 trillion plus deposits that are out there, the FDIC only has, less than 1% of those deposits backed up by insurance. Even the ratio that is fully covered by insurance, they only have something like 1.3% covered. Now, to their credit, I mean, since 1933, they've never not paid on a insured deposit before. But, basically, it's one of those things they don't want huge, vast bank runs happening. And a lot of this is a confidence game. That's kind of the whole game of fractional reserve banking, is that these institutions are inherently unstable. They've also added this liquidity facility. It ironically generally benefits the larger banks because you can only use that facility if you have a lot of high quality liquid assets. And whereas if you look at the long tail of smaller banks, they're generally more loan driven. They hold illiquid loans that they made and that they're not really easily resellable. And so they can't use that particular facility. And so I think we're in an environment where the large banks are pretty well protected, whereas small banks probably still face ongoing challenges. If you zoom out, I mean, the whole system is kind of artificial, right? I mean, when all these banks are building their system on top of the Fed and the Fed is actively managed by a central entity, it's like both sides are bailout. The whole system is kind of one giant ongoing bailout. But yes, this particular action did have characteristics that were at least partially a bailout. I would say that people are going to pay for it, not necessarily through the government budget. They're going to pay through it by their overall cost effectiveness when using banks in general. The Federal Reserve's liquidity facility is backed up by 25 billion in Treasury capital to absorb any losses that they might incur, which seem somewhat unlikely. And so overall, taxpayers are not really sort of taking a direct hit from this, but it is a spread out cost among all market participants. So I would hesitate to compare it to 2008 in most ways, or compare it to a similar magnitude, because it's more of a liquidity problem than a solvency problem. I would say one of the big systemic things to watch is how the Federal Reserve is going to respond to this, because back in 2008, that was a very hard problem to solve. The Fed can solve this practically overnight if they want to cut rates and put liquidity back into the system. But of course, with inflation at 6%, that's not something they want to do, right? So it's really that combination. And this is a theme I've been talking about for a while, which is that the Federal Reserve is kind of fighting 1940 style fiscal driven inflation with 1970 style monetary policy that is mainly meant to curb bank lending, even though bank lending is not the major cause of inflation here in the 2020s. And so I think ultimately the Fed's going to face a choice, which is either let inflation run away or try to backstop the banking system. And it's one of those things where, it's very easy for them to save the banking system if that's what they decide to do, and prevent, a lot of deposits just flowing into the big banks and flowing into money markets. But that comes with a big cost. And it's just one of the challenges of having the actively managed financial system and their ongoing cycle of putting out fires that they themselves caused. And so now the question is, are they going to light another fire and then put that out again, or how are they going to deal with this? He could have left before, and he wanted to be, basically re-put into that position. I think basically anyone who runs a central bank or knows how to run it wouldn't want the job, because in Powell's defense, there's really no good answers here. The system's not designed at this point to handle rate. Just, people often say that if he just has like the guts to be like Volcker, he can fix this. Whereas not really, because it's not a 1970 style problem. It's a 1940 style problem. And, when you have massive fiscal deficits that are causing the underlying inflation, combined with supply side problems in energy and labor and things like that, there's kind of rolling problems there. Monetary policy tools are not really the right tools to address that. Basically it's more of a fiscal type of challenge. And so I think the concerning thing is, by even wanting that job, it's easy to play like central bank, like everything what they could have done, should have done. And that's where I'm hesitant to blame him, other than pointing out that there's really no good solutions here. And it's really the underlying structure of the system that's the problem. Predicting that is basically predicting human behavior, which is challenging. If you look at inflation break-evens right now, the market is expecting low long-term inflation, right? So if someone thinks that's correct, then the Fed's fine. They can hold interest rates, here. They can lower them a little bit, and things will be fine. On the other hand, if they view that that's mispriced and inflation is going to be a recurring problem this decade, then I do think you're going to get recurring losses of confidence in the overall banking system. And some are more vulnerable than others. I think Europe's very vulnerable. The United States a little bit less so, but we can still shoot ourselves in the foot and cause these types of problems. And so I think it's been an ongoing, problem. It's not something that happens overnight in developed markets, but it's something that year after year after year, more and more people begin, kind of questioning that whole thing. Right now, I'm looking at the 2-year Treasury yield, the 52-week Treasury yield, market expectations of forward Fed policy, because we just saw one of the biggest repricings of short-term Treasury yields on record. We have to go back to the 1980s to see a similar rapid move. And historically, when you see the 2-year plunge below the federal funds rate with that speed and at that magnitude, that's kind of a signal that the Fed funds rate is probably done. Now, this cycle has somewhat unprecedented elements to it, so we can see how much Powell wants to kind of push things. But overall, I think the market is basically saying the Fed's done. We're at kind of a pause or mild cut phase of the cycle. Lending decisions are going to be tighter now, which can increase the odds of a recession. And so we'll see what happens. You look at the financial system, you shouldn't have to look at like what one guy is going to decide when he gets out of bed, or like one group of like people. But that's kind of the nature of the system. It's kind of designed, almost like it just consolidates towards like the center over time. And because we're kind of in the later stage of that multi-decade cycle, it's now quite consolidated towards the center. And so watching what the center is going to do is essentially part of how you have to manage assets in this type of environment. Bitcoin and gold, and some stocks that are doing pretty well, and it's things that were rate sensitive. So for example, someone believed that Powell was going to keep hiking, that he was going to get the positive real rates and then hold them there for a long period of time, then the dollar is super stable. And it basically makes it attractive, and it makes most other assets unattractive, right? If you can get a positive real yield on your treasuries and your things like that, it makes other assets less urgent. On the other hand, if they rapidly cut interest rates, and they're not able to tighten even in the face of persistent inflation, then that makes those scarce assets more attractive, things like Bitcoin, things like gold. And so if that breaks perceptions of overall Fed tightness, that is beneficial to those alternative scarce monies. Now, I'd be careful about chasing things in the near term. I mean, short-term moves can always reverse themselves over any multi-week or multi-month period. But I do think that Bitcoin is showing a lot of resilience in the recent months, and especially with this particular event, and that it's this is a good advertisement for Bitcoin. And that's kind of always been part of the thesis. I mean, if someone believes that the dollar is going to get back on track and it's going to stop losing value, then people can hold dollars. Whereas if Bitcoin's kind of the thesis that that's not going to happen, the dollar is going to keep devaluing in purchasing power, even when taking into account interest rates, and therefore that Bitcoin is a better long-term money to hold, in addition to being censorship resistant and global and all the other properties that it has.